Let me ask you something that'll sound absurd at first. If I told you someone just sold enough wheat to feed the entire planet for 3 years, would you believe me? Or would you immediately ask, where exactly was all that wheat stored? That's the question nobody's asking about the silver story dominating your financial feeds right now. According to headlines circulating through trading communities and financial media, China just unleashed 2.1 billion ounces of silver onto global markets. The story's spreading fast, forwarded through Discord channels, Twitter threads, investment newsletters. It sounds dramatic, it sounds significant, and most importantly for those spreading it, it sounds just plausible enough that most people won't actually check the math. Here's what happens when you do check the math. Every silver mine on Earth, from Nevada to Peru, from Australia to Poland, operating at maximum capacity, produces approximately 840 million ounces annually. That's the Silver Institute's verified production data. So this alleged Chinese liquidation represents 2.5 times total annual global production, not 2.5 times what China produces. 2.5 times what the entire world mines in a year. Think about that for a second. Someone would need to have stockpiled more than 2.5 years of total planetary silver production, then decided to dump it all at once into markets that track every major transaction, without anyone noticing the accumulation phase. The story collapses under basic scrutiny. But here's what makes this interesting. While everyone's debating this mathematical impossibility, something entirely real happened that almost nobody noticed. December 27th, 2025. Most traders are planning holiday vacations. Markets are thin. Attention is elsewhere. That's when the CME Group, the organization running the COMEX exchange where silver futures actually trade, published a regulatory filing. Not a press release, not an announcement designed for public attention, just a technical circular, Federal Register 25548. Buried in standard regulatory language, they announced a 23% margin increase on silver futures contracts. Effective date, January 2nd, 2026. Let me translate what that means in practical terms. Imagine you're holding short positions in silver, betting prices will fall. You've posted the required collateral, $8,800 per contract. That's the security deposit that lets you maintain your position. Now multiply that across the market. According to CFTC data, approximately 200,000 silver futures contracts are open. That's $404 million in sudden forced collateral calls, hitting thousands of traders simultaneously on the first trading day of the new year. Think about the timing like this. You're playing chess, and your opponent just announced checkmate in 3 moves. But instead of addressing the board position, they've gotten you focused on a game happening on a different table entirely. Let's connect some dates that mainstream financial coverage keeps separated. December 27th, CME announces margin increases with exactly 4 business days' notice, 2 of which fall on a holiday weekend when most market participants are unreachable. January 1st, China implements export restrictions on 4 critical industrial materials: antimony, gallium, germanium, and graphite. The Ministry of Commerce announcement came in mid-December, giving sophisticated institutional traders enough time to reposition, but not enough time for broader markets to fully price in implications. January the 2nd. New margin requirements take effect. First business day after China's export restrictions activate. Also the beginning of options expiration week for January contracts. Now watch what happened to prices. Within 72 hours of China's export restrictions taking effect, silver prices in Shanghai, the world's largest physical silver market, jumped $8 to $10 per ounce above COMEX prices. The Shanghai Futures Exchange data shows this clearly in early January trading sessions. Stop and think about what that premium means. In commodity markets, when a product costs more in the location closest to physical supply, that signals actual shortage. It's economics 101. Scarcity drives prices higher. If China were truly dumping 2.1 billion ounces onto global markets, Shanghai prices would collapse below Western prices as sellers competed to offload inventory. We're seeing the exact opposite pattern. Shanghai traders are paying significant premiums to secure physical metal. That's not what a dump looks like. That's what a supply squeeze looks like. Here's where market mechanics get fascinating and brutal. Traders holding short positions suddenly faced pressure from 3 simultaneous directions. First, new margin requirements demanding immediate additional collateral. Second, January options contracts expiring on January 10th, requiring either exercise decisions or position closeouts. Third, China's export restrictions, creating uncertainty about future physical supply availability. This isn't speculation about market manipulation. These are documented, publicly verifiable events. The December 27th circular is available on CME's website. China's Ministry of Commerce announcements are official government policy. The Shanghai premium is visible in real-time pricing data. According to trading economics data, silver price volatility spiked 34% in the 72-hour window following January 2nd margin implementation. That's not normal market repricing. That's forced liquidation pressure creating sudden movements as overleveraged traders scramble to meet collateral calls. When you suddenly need billions in additional capital, you face binary choices: deposit more money immediately or close positions to reduce margin requirements. For traders betting on lower silver prices through short positions, closing means buying back contracts in rising markets, which creates its own upward price pressure. It's a liquidity trap with elegant simplicity. Higher margins force liquidation. Liquidation creates buying pressure. Buying pressure drives prices higher. Higher prices trigger more margin calls. The cycle accelerates until someone either deposits massive new capital or gets forcibly closed by the exchange. Now consider who benefits from the fabricated China dump narrative. If you're managing substantial short positions in silver futures, the last thing you want is public attention on exchange margin manipulation coinciding with verified supply restrictions. Much better to flood the information space with an impossible story that sounds plausible enough to casual observers. While everyone debates whether China is selling metal, the real mechanism operates in plain sight through regulatory filings most people never read. Think about it like a magician's misdirection. The audience watches the dramatic gesture with one hand, while missing the actual trick happening with the other. The fabrication isn't meant to withstand serious scrutiny. It's meant to occupy attention during the critical window when actual mechanisms are operating. Let's examine what's actually sitting in COMEX warehouses right now. According to CME delivery reports dated January 6, 2026, registered silver inventory stands at 41.2 million ounces. That's the physical metal available for delivery against futures contracts, the actual silver that can satisfy contract obligations. For context, COMEX held 338 million ounces of registered silver in January 2020. We've watched a 70% decline in deliverable inventory over 6 years. Now apply basic mathematics to that fabricated 2.1 billion ounce dump story. COMEX warehouses hold 41.2 million ounces in registered inventory. Even counting eligible inventory, metal stored in approved warehouses, but not available for immediate delivery, you're looking at roughly 290 million total ounces across the entire COMEX system as of January 2026. The alleged Chinese dump represents more than 7 times the entire COMEX inventory system. It's 51 times the registered inventory available for actual delivery. These aren't rounding errors. These are numbers that reveal complete fabrication the moment you check them against warehouse data that CME publishes daily on their website. While mainstream coverage focuses on impossible dump narratives, look at what major institutions have actually been doing. According to CFTC bank participation reports analyzed by commodity researchers, JP Morgan held a short position of approximately 200 million ounces in silver futures back in 2020. By 2023, that short position had completely reversed. Multiple industry analysts now estimate JP Morgan's physical silver holdings at roughly 750 million ounces, accumulated quietly over 3 years through taking physical delivery on long futures positions and direct bullion purchases. Think about what that position represents. The same institution that once held the largest concentrated short position in silver futures now holds the largest known private stockpile of physical silver anywhere in the world. That's not a position you build if you expect falling prices. That's strategic accumulation by traders who understand something about future supply and demand that is not yet reflected in current market prices. This isn't the first time exchange authorities have used margin requirements as weapons during silver squeezes. January 1980, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had accumulated massive long positions in silver futures and physical silver. Prices climbed from $11 per ounce in September 1979 to $50 by January 1980. COMEX responded with escalating margin increases. According to Federal Reserve historical documents, COMEX raised margin requirements from $1,000 per contract to $6,000 per contract between January and March 1980. That's a 500% increase in collateral requirements during silver as price climb. The exchange simultaneously implemented Silver Rule 7, which restricted new long positions while allowing unlimited short selling. They also established liquidation-only trading rules designed specifically to break the squeeze by making it financially impossible to maintain long positions, regardless of views on silver's fundamental value. The Hunt brothers couldn't meet escalating margin requirements on their leveraged futures positions. On March 27, 1980, known as Silver Thursday, they defaulted on margin calls exceeding $1.7 billion. Silver prices collapsed from $50 to under $11 within months. The exchange successfully used margin policy as a weapon to prevent physical delivery and protect short sellers betting against rising prices. Fast forward to January 2026. We're watching the same playbook with one crucial difference. In 1980, the Hunt brothers faced a purely financial squeeze that the exchange could control through margin policy alone. In 2026, China's export restrictions represent physical supply disruptions that no amount of exchange policy can regulate away. The Ministry of Commerce announcement wasn't vague political posturing. These are specific critical minerals essential to electronics manufacturing, solar panel production, battery technology, and military applications. China controls roughly 70% of global gallium production and 60% of germanium output, according to U.S. Geological Survey data. When they restrict exports, global supply chains face immediate shortages that financial markets can't simply paper over with futures contracts. Look at what happened immediately following implementation. Within 3 trading days, Chinese silver prices jumped $8 to $10 per ounce above COMEX prices. That premium signals actual physical shortage in the world's largest silver refining and manufacturing center. If abundant supply existed, arbitrage traders would immediately buy COMEX silver and ship it to Shanghai to capture that premium until prices equalized. The persistent premium proves physical delivery from Western exchanges into Chinese markets isn't happening at scale. Here's the calculation that explains why fabricated narratives become necessary at specific, calculable moments. Each silver futures contract represents 5,000 ounces of metal. With 41.2 million ounces available in registered inventory, that's enough physical silver to satisfy 8,240 contracts demanding actual delivery. According to latest CFTC data, total open interest in silver futures stands at approximately 200,000 contracts. That represents roughly 1 billion ounces of paper claims against 41.2 million ounces of physical metal. Do the division. We're looking at a 24-to-1 ratio of paper promises to available physical inventory. But the real leverage ratio goes higher when you account for unallocated silver holdings in ETFs, bank certificates, and pool accounts representing additional paper claims against limited physical stocks. Industry analysts estimate the true paper-to-physical leverage ratio approaches 250-to-1 when including all forms of synthetic exposure. Think about what that means practically. If just 0.4%, less than half of 1% of paper silver holders decided to take physical delivery, they would completely drain COMEX registered inventory at current levels. That's not a market functioning with normal supply and demand dynamics. That's a system operating on the assumption that physical delivery demands will remain rare enough to never test available inventory. Now apply China's export restrictions to this equation. According to industry trade data, China exported approximately 6,000 metric tons of refined silver in 2024. That's roughly 192 million ounces annually flowing into global supply chains. The January 1st restrictions on antimony, gallium, germanium, and graphite represent strategic resource controls signaling broader policy direction regarding critical mineral exports. Notice what happens when you remove 192 million ounces of annual supply from a market where total registered COMEX inventory stands at 41.2 million ounces. The mathematics get uncomfortable quickly. At current daily withdrawal rates visible in CME warehouse reports, registered inventory declines by approximately 300,000 to 500,000 ounces weekly. That's 1.2 to 2 million ounces monthly, or roughly 14 to 24 million ounces annually at present velocity. Project forward. If registered inventory continues declining at the low end of current rates, COMEX holdings fall below 27 million ounces by late February 2026. At the high end of current withdrawal velocity, we hit that level by mid-February. Why does 27 million ounces matter? Historically, when registered inventory falls below 30 million ounces, CME Group begins preparing contingency protocols for potential delivery disruptions, according to exchange procedures documented during previous tight supply periods in 2011 and 2020. There's a specific forcing event arriving in exactly 5 weeks, February 14th, 2026. That's when January silver options expire. According to CME options data, significant open interest sits in call options between $32 and $38 strike prices. If silver trades above these strikes at expiration, those options convert to long futures positions requiring margin deposits and potentially demanding physical delivery. Let me walk through what happens during options expiration in a tight physical market. Call option holders who exercise receive long futures contracts. Those contracts can either be closed for cash settlement or held for delivery at contract maturity. In normal markets, most options settle financially without physical delivery. But when physical premiums exist, as evidenced by the current $8 to $10 Shanghai premium over COMEX, arbitrage opportunities encourage taking delivery at lower COMEX prices and selling into higher physical markets. If even 10% of in-the-money call options demand delivery at February expiration, we're talking about potential draws of 2 to 4 million ounces against registered inventory already declining at 1.2 to 2 million ounces monthly. The mathematics start cascading. Each delivery reduces available inventory, which increases pressure on remaining shorts, which creates incentive for more delivery demands, which further reduces inventory in an accelerating cycle. Then comes March 2026. The Bloomberg Commodity Index rebalances quarterly based on production and liquidity metrics. According to Bloomberg's published methodology, silver's weighting in the index adjusts based on prior 3 months of production data and open interest levels. When commodity funds tracking the index must adjust positions to match new weightings, they create forced buying or selling regardless of fundamental views on value. Here's where timing becomes critical. If silver inventory remains tight through February options expiration, March rebalancing happens into a market already experiencing physical stress. Index funds can't choose to delay rebalancing trades. They must execute by specific dates to maintain tracking accuracy. That creates predictable, forced buying pressure that sophisticated traders can position ahead of. Let's calculate potential price targets using historical precedent as baseline. In January 1980, when silver hit $50 per ounce, that represented approximately 38 times the gold to silver ratio and roughly 2.8 times the Dow Jones Industrial Average, its daily point level. The Dow traded around 18,000 points while silver touched $50. Apply that same ratio to today's Dow at 40,500. Silver reaching 2.8 times the Dow's point level projects to roughly $119 per ounce. But that's using the conservative multiple from 1980. If we use the more extreme gold-silver ratio compression that briefly occurred when silver traded at a 15-to-1 ratio against gold, current gold prices around $2,150 per ounce would project silver to $183. However, these historical ratio calculations miss the critical difference between 1980 and 2026. The Hunt brothers' squeeze was purely financial. They accumulated silver through leveraged futures and physical purchases, but global mine supply continued flowing normally. COMEX broke the squeeze through margin increases and position limits alone because no external supply disruption existed to sustain the shortage. In 2026, we have external supply pressure from China's export restrictions, removing 192 million ounces annually from global refined supply chains. That's physical supply disruption the exchange can't regulate away through margin policy. When paper markets meet physical supply constraints, prices don't just rise to historical ratio levels. They spike to whatever level brings physical supply and paper demand back into equilibrium. Here's what that equilibrium calculation looks like. If current paper leverage ratios of 250 to 1 need to compress to sustainable levels around 25 to 1, that requires either a 90% reduction in paper open interest or a 1,000% increase in physical inventory backing those positions. Physical inventory can't increase 1,000% when Chinese supply is restricted, so the adjustment must come through paper position reduction. How do you reduce paper open interest by 90% when holders believe physical shortages justify higher prices? You force liquidation through escalating margin requirements. Exactly what CME is doing, but here's the catch. Each margin increase accelerates the timeline by forcing current position holders to close before they intended to. That concentrated selling pressure shows up as price volatility, which CME then cites as justification for further margin increases in a self-reinforcing cycle. The breaking point arrives when enough paper shorts decide to close positions simultaneously that buying pressure overwhelms available sellers. According to CFTC bank participation data, 4 major U.S. banks held concentrated short positions totaling approximately 280 million ounces of paper silver as of December 2025. If those institutions begin covering even 25% of their short exposure, that's 70 million ounces of buying demand against 41.2 million ounces of registered COMEX inventory. Here's the timeline that documented evidence suggests. Late February 2026. Registered COMEX inventory falls below 25 million ounces at current withdrawal rates. That's the threshold where CME historically implements emergency protocols. March 2026. Bloomberg Index rebalancing requiring forced position adjustments by commodity funds. April 2026. Next major options. Expiration where remaining shorts must either cover or roll positions forward into increasingly expensive margin requirements. The price targets depend on how the paper market adjustment unfolds. If shorts cover gradually over several months, prices might reach $45 to $65 based on gradual supply-demand rebalancing. If concentrated short covering happens in compressed time frame, we could see $85 to $140 as panicked buying meets physical constraints. If the system experiences actual delivery failures, where futures contracts can't be satisfied with physical metal, prices spike to whatever level brings physical supply holders to market potentially $200 to $320 based on 1980 ratios adjusted for current supply dynamics. Here's what makes the fabricated China dump narrative essential for insiders to propagate right now. If retail investors understood the real mechanism, margin traps converging with physical supply restrictions during options expiration and index rebalancing, they would aggressively buy physical silver and take delivery immediately. That would accelerate the inventory drain and bring the breaking point forward from late Q1 2026 to mid-February or earlier. The fabrication exists to buy time by flooding financial media with mathematically impossible dump stories. Attention stays focused on whether China's selling rather than on CME margin increases and declining registered inventory. While retail investors debate fabricated narratives, sophisticated institutions adjust positions based on actual warehouse data, real margin requirements, and documented supply restrictions. So when you hear stories about China dumping 2.1 billion ounces of silver, remember that number represents more than 3 years of global mine production. Check it against COMEX registered inventory of 41.2 million ounces. Verify the December 27, 2025 margin increase documented in CME Circular 25-542. Confirm China's January 1st, 2026 export restrictions through Ministry of Commerce announcements. Those are the real numbers, revealing the real mechanism. Paper leverage ratios of 250 to 1 meeting physical supply restrictions during options expiration and index rebalancing create a calculable breaking point. The February 14th expiration, March rebalancing, and late Q1 inventory threshold represent specific dates when the system's fragility gets tested. Fabricated narratives become necessary at precisely the moment when insiders recognize those dates matter more than most market participants understand. Think about your own silver holdings in this context. Whether you own physical coins and bars, shares of silver mining companies, or ETFs like SLV, the coming weeks determine whether you're positioned for sharp repricing or caught in paper positions that can't access physical metal when delivery matters. Our job isn't predicting whether the paper market breaks or believing impossible dump stories. Our job is recognizing which numbers represent documented reality and positioning accordingly. While the fabrication still obscures the mechanism from broader awareness, the timeline is visible in CME circulars, warehouse reports, and Ministry of Commerce announcements. The mathematics are straightforward once you know which data to trust. The rest is just noise designed to keep attention somewhere other than the actual breaking points visible in late February through early April 2026.